Hello, everybody, and welcome to the Sensitive Security Podcast. Today, we are going to talk about earnings calls with economist James Gentry of Invest Mentor. Hi, James. How are you?
I'm doing well, Mary. How are you?
Good. So, in a nutshell, what is an earnings report?
I like to think of an earnings report as their financial report card. Every 3 months, public companies disclose revenue, profits, earnings per share, key business metrics, tend to include things like financial statements, the management commentary explaining their performance and where they want to go. And after releasing the report, they end up having an earnings call where executives walk through the results and open questions to some analysts.
So, that brings up a good question. So, how often do companies report earnings?
Companies report every 3 months, U.S. public companies every quarter. You have your 10Q quarterly reports, which are unaudited. Then you have your K10 audited reports, which are basically for the full fiscal year. But earnings season happens 4 to 6 weeks after each quarter ends. So think January, April, July, and October. European companies will often have semi-annual reporting through, though larger institutions, everybody reports quarterly.
So, my experience is when you go on an earnings call, there's some opening remarks. And so what should a beginner investor listen for in those remarks?
But you can go on NASDAQ and figure out and see the reporting or the earnings that are going to be happening for that day or that week. And they have a little sun or little moon, and that's before hours or after hours that you can take a look at for diving into it. But some of the opening remarks, I would say overall performance narrative. Did they meet or beat expectations and what drove results? Other key metric drivers like revenue growth sources, new customers, price increases, market share. What really changed from the previous quarter? And then tone and confidence. Does management sound confident, or are they slightly vague and defensive on kind of what it is that they're trying to convey on this report? It's usually good to focus on the clarity aspect of it.
So you may have already answered this, but when the CFO goes through the results, what are the two or three things to focus on?
Three things that I would focus on this particular question would be revenue growth trends. Are they growing? Is it flat? Are they declining compared to the previous quarter or year over year? And at what clip? Is it accelerated growth, or is it still growing, but just at a slower pace? Then I would look into margins, gross margins, operating margins. Are they expanding? Price power efficiency or compressing, which usually hint to cost pressures or competition, so eroding market share. And then the third thing would be cash flow and guidance. Did they generate cash or consume it? And what's free cash flow and what's the outlook for the next quarter?
And that all depends on the type of company that you're listening to, right? Is it like a brick and mortar? Is it an industrial? Is it a growth company more value oriented, right?
Yeah, because even small beats or misses moves stock markets, and any sort of shock to the system will impact their share prices.
So often towards the end of the call, they have a Q&A session. Why is this really important?
That's a really good question. Q&A, I like to think of it like the unscripted truth, like what's happening behind the scenes. So the prepared remarks, they're polished, right? If you're going to an earnings call, they've gone through everybody, but the Q&A really shows how management is going to be thinking under pressure. And this really matters for a few reasons. The analysts what they'll tend to do is the release happens about an hour or so before the earnings call. So they'll probe for any weak spots that they find out. And if they haven't been reported on in a call, they'll take the time to bring them up within these calls. You can tend to see how executives handle these types of tough questions, forward-looking commentary that often usually emerges in the Q&A section tend to give like vague guidance, but analysts will encourage them to dive a little bit deeper into it. What does this mean? You said this, could you explain further? And these add a little bit more clarity to the markets. And ultimately the thing that I found the most interesting is tone shift between Q&A and then their prepared remarks. Are they still as confident in the Q&A section, or do they become a little bit more defensive? red flags that come to mind are like vague answers. Are they refusing to quantify some of the things that are disclosed? Some of the excess, did they excessively blame some things on external factors? Did they pivot from a confident to a more defensive approach? And is it more contradicting to their prepared remarks? So this Q&A section is really the best part, in my opinion, of the whole thing, because you can get into the weeds a little bit.
Yeah, we like that. So can any investment analyst ask questions, or just the ones publicly covering the company? Can the general public also just chime in and ask questions too?
The public can't just chime in and ask questions. I know it's quite unfortunate because there have been some times I was like, I'd really like to know the answer to this question. And you just really hope that an analyst asks it or a question adjacent to it. But anyone can listen, but participation tends to be a bit restrictive to credentialed analysts, primarily because you have a time constraint of 1 hour, and then they have a quality control factor that really that's the structure within the call itself. Usually they'll prioritize it in some sort of pecking order. So some analysts from top firms tend to get priority.
And so I've never heard this term earning whispers. What is that all about?
Okay. So it's the crowdsource estimate. So think of it like the grapevine. Okay. It's an unofficial estimate that kind of differs from the original analyst consensus. They represent what the market actually expects the company to be versus what the published estimates are. Like you start seeing people purchasing more AI chips, you're thinking, okay, certain stocks are going to climb on the back of this. And so even though consensus this, I think they're going to beat. And so these whispers start to create and propagate through the grapevine. And it's interesting how they matter because official estimates could be quite stale, whereas whispers could reflect more real-time sentiment. It's like a sentiment gauge for the individuals. A company can beat an official estimate, but the whisper, if they don't beat the whisper, the stock will tend to fall. So an example would be like an official consensus. Say that you have the consensus is at $1. Like they think you're going to beat earnings by $1. EPS comes in at 1.5, but the whisper said 1.10. You start to see a decline in the stock because though it beat consensus, it didn't match the sentiment that was being propagated through this grapevine. So it's an interesting thing to be aware of.
Can a company show profits but still have money problems?
Absolutely. Working capital is completely different, right? So you're looking at like revenue booked versus not collected, reports for profit from sales, but the customers haven't necessarily paid anything. Think of like a net 90. So, you have your accounts receivable pile up with no cash. Then you have heavy capital spending, profitable, but burning cash on equipment or expansion.
What are some simple signs that profits may not be high quality?
Profits growing faster than revenue. If net income surges, but revenue is flat, you gotta ask why, right? Could be cost cuts. You have short-term boosts, accounting adjustments, or some of these one-time gains. You have weak or negative cash flow. Strong net income, but weak operating cash tends to mean that the profits aren't necessarily converting to cash. Rising accounting receivables faster than revenue. So think of like customers that aren't paying, revenue booked isn't cash collected again. Declining gross margins, lower pricing power, and facing rising costs. And then you have some of these one-time items like asset sales or tax benefits, or you got to strip these out to see more of the core profitability.
So what does it mean when people say results were priced in?
I would say that the market is more or less anticipated exactly what was going to be materialized. So the results and the adjusted stock price before the announcement, everybody knew it was going to be needed. Like if consensus, the whisper and everything meets it. Previous example, if everything met $1, if everyone expects strong earnings and investors buy ahead, it pushes the stock up. When results come out, even if great and there's no surprise, the stock doesn't really move or fall. So it's more or less kind of trading in the consolidated window in which it was prior to the release.
So what matters more, the quarter that just happened or what the company says about next quarter?
Guidance about next quarter in my opinion, would matter most because markets are primarily forward looking. Past quarter is done. Investors want to know, okay, can you continue the growth, or if you got yourself into a rut, are you able to get yourself out of the rut? The past is in the past. How can we continue to grow in the future? Yeah, that's my take on it.
So, how do you compare results to prior quarters and years and not just expectations?
Looking at trends over multiple periods, year over year, quarter by quarter, or multiple patterns, like you take a year over year comparison, Q1 24 to 25, it eliminates a lot of the seasonal things that you'll start to see. So you have like strong retail signals that happen usually in the December quarter. So you looking over the year will help smooth out what those metrics are, whether when you look sequentially quarter over quarter, compare 1 to 4 shows immediate momentum, but can be distorted by these seasonality trends. So looking over quarter and year over year is going to be ideal, taking both.
And last question, what are non GAAP or adjusted earnings and should I trust?
That's actually a good one. Should we trust non-GAAP?
What
So,
is non GAAP anyway?
so GAAP stands for generally accepted accounting practices. Non-GAAP is non generally accepted accounting practices. The standard accounting practices, more or less, these earnings include all expenses, one-time charges, stock compensation, restructuring, everything. Non-GAAP removes those certain one-time expenses to show the core. And you could think of it as ongoing profitability rather than a singular event that happens. Think of like acquisition costs for an M&A transaction or one-time legal fees that were settlements. So the non-GAAP pulls that out so you can see the core growth. So it is something that you should weigh on both sides. But I would use caution with non-GAAP because it could be useful to understand more or less the core operations, but it can also be abused, right? Some companies exclude legitimate recurring costs to make some of the results look better. So knowing the difference and knowing what you're looking at in that regard, that's going to be key in that aspect.
Good. So, I think we touched on a few things for this
Okay.
episode. There is so much more to talk about, I'm sure. But this also ties back to our last podcast, financial statements. So we'll link this so people can see it. You should see it pop up if you're watching this on YouTube. We'll also include it in the show notes. But once again, James Entry, thank you of Invest Mentor for explaining all of this to us very clearly. We really appreciate it. Thank you.
Yeah, absolutely. And before I go, just wanted to say that the Investment Mentor app actually just released their Understanding Earnings course as well. So if you guys want to know a little bit more and dive into kind of the nuances of it, feel free to download the Investment Mentor app. And thank you, Mary, for having us.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice.
IBKR Invest Mentor is a service of Interactive Academy LLC, an affiliate of IB LLC and majority owned by IBG LLC. All content provided by IBKR Invest Mentor is for informational and educational purposes only and should not be interpreted as implying any sponsorship, partnership, endorsement, recommendation, or approval by IB LLC or its affiliates.